Doing cross-border business is more than just a long-distance logistical challenge. It also involves documentation. Documentation that the seller of the goods prepares or obtains, and that the buyer of the goods requires in order to gain possession of that merchandise. Cross-border buying and selling of goods revolves around exchanging these documents for payment, which in turn opens up a middle ground between open account and prepayment, a space where intermediaries conduct the exchange of documents for payment and may even provide necessary financing. Documentary collections as a payment mechanism is used in these circumstances. In a documentary collection scenario, documents are entrusted to a bank for delivery to a buyer only after the seller's collection instructions are met. Typically, these documents include the commercial invoice, the bill of lading, and other necessary papers required for customs clearance and the collection of goods. The bank acts here as a collection agent, i.e., it does not assume any responsibility for payment. Neither the commercial risk associated with the buyer nor the risks associated with the buyer's country are mitigated. We will cover these risks in a later episode of Trade Finance in the Spotlight. Documentary collections can be one of two types: documents delivered against payment or documents delivered against acceptance. In this section, we will discuss documents delivered against payment. Under the terms of documents delivered against payment, the buyer is required to pay prior to receiving documents from the bank. The documents will typically include a document of title, such as a bill of lading. From the seller's perspective, there is a risk that the buyer will refuse or fail to pay. In that case, the buyer will not receive documents from the bank and usually be unable to take delivery of the goods, meaning the goods will need to be stored and insured at the port while the dispute between the parties is resolved. The ability of the seller to exercise control over title to the goods depends on having a title document, such as an original bill of lading, as in most ocean shipments, which is released to the buyer only after they have made payment. This control is not available when making air shipments because an airway bill is not a title document. The second type of collection is documents against acceptance. Under the terms of documents against acceptance, the buyer is able to take delivery of the goods on acceptance of a bill of exchange, which evidences their debt to the seller. So the risk of a dispute resulting in the need to store goods at the port is reduced compared to collection against payment, although the buyer could refuse to take delivery of the goods for other reasons. In contrast to open account trading, the seller does at least hold an accepted bill of exchange as security, although the buyer holds possession of the goods. While the seller should be able to anticipate the collection of funds on the maturity date of the accepted bill of exchange, there is still a risk the buyer will refuse to honour the bill of exchange on maturity. In these circumstances, the seller may need to pursue payment through the courts in the buyer's jurisdiction. Another concept in collection is called avalization. It is possible for the seller to strengthen its position under documents against acceptance by requiring the buyer's bank to co-accept the bill of exchange. This is called avalization. This concept is called documents against acceptance pour aval. Under avalization, the buyer's bank is required to co-accept the bill of exchange before documents are released to the buyer. Under these circumstances, the buyer's bank must pay on the maturity of the bill of exchange even if the buyer is unable or unwilling to pay. Therefore, the seller is exposed to the buyer's bank risk instead of the buyer's risk. In this section, we will discuss risks and benefits to the buyer under documentary collection. Trade using documentary collections is slightly more burdensome for the buyer compared with open account trading. The buyer's main risks are that they get to see the goods only after effecting payment or accepting a bill of exchange. Therefore, they are open to risk of receiving goods which are damaged during shipment, or that the shipment is incorrect, or that the goods are held by customs. The buyer may be able to appoint a third party to inspect the goods prior to making payment or accepting the bill of exchange with prior agreement of the seller. Such agreement must be included in the terms of the collection. As with open account trading, the buyer can still defer payment using the seller as a source of finance by using documents against acceptance rather than documents against payment. In this section, we will discuss risks and benefits to the seller under documentary collection. As with open account trading, the exporter faces a risk of non-payment by the buyer after the delivery of the goods. Using documents against payment as the preferred type of collection offers the seller greater protection than documents against acceptance, especially when a document of title, such as a bill of lading, is included in the documentation. This is because the seller can still exercise control over the goods and can either find another buyer or arrange to have them returned. In the case of documents against acceptance, the seller faces a risk of non-payment by the buyer on the maturity date of the bill of exchange. This can be mitigated by requesting the buyer's bank to avalize the bill of exchange. The seller also faces the country risk of the buyer. It is important for the seller to assess this risk prior to entering into the transaction. In this section, we will review documents and their associated rules. It is crucial that the seller and buyer are aware of the appropriate local rules which may apply to their transaction. For example, some countries apply stamp duty on bills of exchange, so it is important to factor the additional cost into any pricing. Requirements for export or import licenses should also be considered. Preparation of the documentation is central to the documentary collection process. Negotiation of terms whilst the transaction is being agreed will ensure the documentation is as accurate as possible, reducing the risk of confusion or dispute later. This may add cost to the procurement process, as resources need to be committed to the scrutiny and preparation of appropriate documents.